Hey everyone, welcome to Fundamentals Unfiltered. I'm Matt with the Fundamental Investing Institute. We are recording this on December 16th, 2025. And on today's episode, we're going to discuss the Fed's most recent rate cut and also some reporting on the next Fed chair that's come out in the last week or so. I'm sure everyone knows by now the Federal Reserve last week announced a 25 basis point cut in the federal funds rate. So that is a one quarter of 1% cut. The target federal funds rate is now 3.5 to 3.75% because the Fed establishes a target range that they try to keep the federal funds rate in. And for those who may not know, the federal funds rate is just the overnight rate that institutions, or banks mostly, charge each other. And the Fed targets this rate. This is their key rate. It does not directly set things like mortgage rates and business borrowing rates. That rate is influenced by the 10-year bond yield, which is something that the Fed can influence but not directly control. And actually, in the recent 6 months or so, maybe even longer, the 10-year really hasn't followed the direction of the cuts in the federal funds rate. Now, the Federal Open Market Committee, this was on the 10th that they met and announced this cut. Remember, there's 12 voting members on the Federal Open Market Committee. Stephen Myron, who is one of the board governors, he is actually a member of the administration on leave. He's the head of the Council of Economic Advisors. He's on leave of that right now to serve temporarily on the Federal Reserve Board. He's been lobbying for a bigger cut. So 9 members voted for the 25 basis point cut. Stephen Myron dissented, voting for a larger cut. He wanted a 50 basis point cut. And 2 regional reserve bank presidents, I think it was Chicago and Kansas City, voted for no cut, citing higher inflation risk. And being a monetary conservative myself, I did not think that a cut was justified, but nevertheless, they cut 25 basis points. Jerome Powell did a news conference, as he always does, and he made some interesting points, but it seems like they're done cutting for a while. And that brings us to another issue, which is Powell's term is up in May, and the president is almost guaranteed to replace him. He's been interviewing a number of candidates, but for a while, I'd say mostly last month, it looked like he was down to a single candidate, which is Kevin Hassett. Hassett is the head of the National Economics Council. He's someone who, on paper, is very well qualified for the job. PhD academic economist with a lot of government experience. But there's been a lot of reporting recently that some big players in the bond market, even some members of the administration, are voicing concern. Hassett is questionably not as independent as the bond market would like. And I'd say in the last 10 days, maybe, there's been some reporting that another candidate has come up. This is a man named Kevin Warsh. I mentioned this before because previously there were 4 or 5 candidates that were kind of being mentioned in the press as possibly being the next Fed chair. And it looks like now we're down to 2. Now, of course, this president is very unpredictable, so there could be some wild cards in there. But we're supposed to know next month who his pick is going to be, that's going to be out there. Kevin Warsh is an interesting pick because he's kind of a monetary conservative. So he's someone who, at least on paper, would not seem to be as accommodative to the president as it would seem, but I still think there's some level of market discipline. And one of the points that I would want to make is, the president's way in giving his opinion on where interest rates should be. I don't know what he's basing that on other than his own intuition, I guess, which a lot of people trust, but I think it's a really bad idea to politicize the Fed. for reasons that I'll probably talk about in depth on another video. But in any event, he's been saying in recent reporting that he'd like to see the federal funds rate at 1% within a year. And actually, there's a very objective way of knowing that the market does not agree with him on that point, and that's by looking at the yield on the 2-year. So here's how we think about longer-term bond yields. If you wanted to invest over some period of time, you can just buy a series of short-term Treasury bills, right? Say 3 months, and then you can roll it over into another one and another one, and you can do that over whatever period you want to invest over. So in that sense, longer-term bond yields reflect an average of expected short-term bond yields. So when you look at the 2-year, that's essentially the market's guess of where short-term bond yields will be in the near term. And right now, it's about 3.5. The 2-year has been about 3.5%. I haven't checked it this morning, but so it's effectively flat with where the federal funds rate is today. What the market is telling you with that is that the federal funds rate is not expected to move anytime soon. And this is important given that the rate of inflation, whether it's the consumer price index or the personal consumption expenditure index that the Fed follows, that's been nearing 3%. There's really nothing on the inflation side that would justify aggressive cuts. So unless we have a big economic slowdown, I don't really see that happening, or you see just inflation come falling down. For a lot of reasons, I don't see that happening either. So point being, I would not expect a sharp reduction in short-term bond yields unless we see a major politicization of the Fed. And if that happens, you're probably going to see chaos in other areas of the bond market. Now, that brings me to a point I think a lot of people are missing here. I don't know if it's a high probability event, but it's a possibility. And this is going into the new year. Of course, we're going to get a new Fed chair in May. And that is when Jerome Powell's term as Fed chairman expires, right? So the Fed chairs are always nominated to or appointed to a 4-year term. But what a lot of people don't understand is that the Fed chairman is also, the Fed chair is also a member of the Federal Reserve Board of Governors. And as the Federal Reserve Board of Governors, they can serve a full 14-year term, and that's in addition to any partial term that they serve. So in Jerome Powell's case, he served a partial term. There was an academic that served on the board named Fred Mishkin, who stepped down maybe in 2008 or so. I don't know, but actually that seat went unfilled for a while, but then Powell came in 2012. And in 2014, he was nominated to his first full term. So the point is, his full term as member of the Federal Reserve Board of Governors goes until 2028. So by tradition, in the past, when we think of Fed chairs, if there was any differential between their term as Fed chair and their term as Federal Reserve member, Board of Governors member, they would resign from the Board of Governors. That's a tradition. That's not a law. They don't have to do that. And in fact, there's a historical precedent for a Fed chair to remain on the Board of Governors. And there was actually a good article in the business section in the New York Times about this. So when this happened was in the late 1940s. Remember in 1935, you had the Banking Act. And the Banking Act really established the modern Federal Reserve, or at least the modern structure of the Federal Reserve. And the first chairman was a man named Mariner Eccles. He was a Mormon banker who was an advisor of President Roosevelt, and he became the first chairman. During the Second World War, the Treasury, of course, they had their funding needs in order to fund the war, and the Federal Reserve was very accommodative of that. So they artificially suppressed interest rates. And then you had wartime price controls, which kept a lid on inflation, but could not do so indefinitely. So when the war ended, you had this spike in inflation. But then you had conflict breaking out in Korea, and President Truman, wanted the Fed to be accommodative for that conflict as well, despite the fact that inflation was heating up quite significantly. So Mariner Eccles and President Harry Truman were really in a conflict on that point. So Eccles' term as Fed chairman ended in 1948. So President Truman effectively pressures him. Well, his term ended, but President Truman was trying to pressure him to resign from the Board of Governors as well. He did not. So Truman puts in a man named Thomas McCabe, who I think history has shown to be kind of a pretty weak Fed chairman, but nevertheless, puts in a man named Thomas McCabe. Mariner Eccles stays on the board and fights it out with Truman. And in 1951, there was something called the Fed Treasury Accord, which a lot of economic historians view as the real birth of Fed independence. And all this is an agreement between the Federal Reserve and the Treasury, saying that the Federal Reserve was going to act independently of the funding needs of the U.S. government and focus really on their inflation mandate, which at the time was more implied than anything. The modern mandate of the Federal Reserve came about in the 1970s. But the point is that Mariner Eccles stayed on from 48 to 51, stayed on the Federal Reserve Board, was in a lot of cases, especially with the fight with the Truman administration, was more of a leader in that than the actual Fed chairman, Thomas McCabe. So point is, you have a precedent for Jerome Powell to stay on until 2028. I don't think that's going to happen, but it's possible. And it will be interesting if it does happen. Now, getting back to the two candidates for the Federal Reserve Board, I've read there's been a lot of reporting recently that Kevin Hassett is kind of losing the confidence, as I mentioned earlier, of a lot of big players in the bond market. And so even though he's the one who has been at least publicly endorsing rate cuts the most, Kevin Warsh is now back in contention. I don't know what that's going to look like. I will say Kevin Warsh is more of what's called a monetarist. And if anyone's unfamiliar, monetarism is more of a focus on money supply growth than other variables. And from what I've read from a lot of Kevin Warsh's commentary, he's been doing a lot of interviews and writing op-ed pieces and stuff. He's been very critical of the Fed in many ways, but he wants the Fed to focus more on money supply growth than they really have in the past. That would seem to be opposite of the president's push for looser monetary conditions. So it's going to be interesting to see how that plays out. As I said, one of the things I want to do is I want to make a video, because we try to keep these videos under 20 minutes or so, around 20 minutes. I really want to devote an entire video to this as to why Fed independence is so important. One thing I'll just say now is because the world is on a fiat money system, meaning that money is not backed by gold or any other commodity, central bank independence and central bank credibility is critical to anchoring what we call inflation expectations, right? And then inflation expectations represent a premium on bond yields. So the higher inflation expectations are, the higher bond yields are. So in a lot of ways, modern central banking is really about managing inflation expectations. I will do a deep dive on that in another video, but it's just something that I want to mention for the time being, because I think this is going to be a key issue coming into the new year. It's one of the things I never like is you have a lot of investment firms and market commentators and others, usually around the end of the year or early in the new year, they'll talk about the coming year and they'll make predictions. I don't like to do that. I think the only intellectually honest answer to what the new year is going to hold is that no one knows. But there's no question in my mind that questions about Fed independence and who the next candidate is going to be and whether they gain the confidence of markets. That's going to be a key issue coming up. Another thing to consider, too, is you have a Supreme Court case coming up where the president, remember earlier in the year, the president was trying to terminate Lisa Cook and really didn't seem to have the authority to do so, but the Federal Reserve is going to have an explicit ruling on that. I want to say that's coming up next month, maybe if not a little bit later in the year, but that's going to be a very important court ruling and could shape markets in ways that we have not seen for a number of years. Now, moving on to my book recommendation for the week. Normally, I like to show the book that I am using. I have a pretty extensive personal library, but I cannot find this book for the life of me, so I'm just going to mention it. And this book recommendation is actually kind of serendipitous because the author is a man, a journalist by the name of Robert Samuelson, and he just passed away a couple of days ago. You know, Robert Samuelson, he was an economics journalist. I was reading his couple of his obituaries that were in different publications, but he put out a book in 2010 called The Great Inflation and Its Aftermath, and it was actually a very bold book because in 2010 no one was talking about inflation, and he was trying to remind people about the great inflation of the 60s and 70s and how this really disrupted the geopolitical climate the world over and changed things tremendously. So this came out in 2010 and it's definitely worth a look because it talks not only about a lot of the economic and political conditions in the 60s and 70s, but as the title implies, it talks about what the social, political, economic fallout was of the inflation, and then also Volcker coming in. Paul Volcker came in 1979, became Fed chairman, and it took some extreme measures to bring inflation down. And by every indication, the market started to boom really in 1982, but it was a very painful period for a couple of years while the Fed was trying to break the back of inflation. So it's an important story. Samuelson was very good at taking esoteric economic concepts and turning them into layman's terms, as it were, and spinning very good stories around them. So he retired, I think, in 2020 as a journalist. He was 78 years old. My understanding is that he died of complications from Parkinson's disease. But his reporting is great, too, if you can go back and look at any of his reporting. I mean, he certainly had a political viewpoint or a political worldview, but nevertheless, he was very good at explaining economic concepts. Very few journalists can do that nowadays. I know firsthand, I try to do that myself, and it's very hard to do, but he was very good at it. So this book is called The Great Inflation and Its Aftermath. It was published in 2010. It is still in print, and it is a very important book to read, especially now. So with that, I wish everybody a great week. We're coming in on the end of the year, and I want to cover two things. One is I want to cover the independence of the Fed and devote a full video to that. And then also I want to do a video, and it might be my last one for the year, where I just touch on a couple of key points that I think are kind of hanging in the air as we get into the new year, and that'll inevitably be big issues going into January of 2026. Already touched upon some of the Fed stuff, but we'll talk about that and some other issues that are hanging in the air. So next couple of videos, we'll wrap up the year, go into the new year, January 2026. Hope everyone has a great week. As always, focus on the fundamentals.